What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is July 6th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to have a candid one-on-one conversation with you guys about my thoughts on the crypto markets going into the next 3 to 6 months. And I know that this is a very difficult time for so many of you out there. With the market being down around 70%, a lot of people are curious about whether or not this is a time to go all in, take advantage of the buying opportunity, or if any time we see strength, we should sell our existing positions into that strength and wait in cash for a lower entry point. These are fair questions to be asking, and I want to spend some time to provide as non-biased of an opinion as it possibly can. So if you guys enjoyed this video, drop a like, consider subscribing, and let's go ahead and dive into the conversation here today. Now, I want to go ahead and get one thing straight out the gate here and start off with the conversation of crypto, even though we will be diving into the macro environment. I think there's a big misconception with some people who watch the channel here, and that can be by taking a look at my titles or my thumbnails, immediately assuming that I'm absolutely bearish on cryptocurrencies. And I want to make clear, guys, that that is far from the case here. Long term, I'm absolutely bullish on cryptocurrencies. I love crypto. I think that it's got a great potential as an asset class. And outside of that as well, we've already started encouraging people that right here, right now is practically good dollar cost averaging territory, albeit over a longer term time frame, over the next 3 to 6 months. And there's a reason why we're emphasizing a long dollar cost average period, one in which is focused on taking advantage of the gloomy environment that we're currently in the macro perspective, over the next 3 to 6 months to get some great entry points. It is not focused, on the other hand, on capturing absolute bottoms, trying to catch a falling knife and hope that our prediction, our bet, our stake here in the market is the absolute low. That's the biggest mistake that a lot of people are making here. So when we talked in one of our previous videos back about a week or so ago, we talked about the 200 EMA and the 4-hour time frame, utilizing this exponential moving average as a means to see resistance and support within price. And this has been an incredibly relevant metric here, alongside many others that will help to signal whether or not we are in for that long-term reversal. And this is where an important question comes in. For a lot of people out there who are making these entries in the market, we need to be very clear about what our entry is. Is it a short-term trade to take advantage of oversold periods and then sell at a slightly higher price to make a short-term return? Or is it making a long-term entry? Because if it's just a short-term trade, I'll be honest with you guys, I wouldn't disagree with the fact that we may see a nice short up rally here in the market. We might see a nice little bump up here to $23,000. Heck, we've been pointing out for weeks now, since back here in mid-June, for nearly a month now, since the rebound in altcoins, the fact that altcoin dominance, when we're really even excluding ETH and stablecoins, have leapfrogged here. Their Bitcoin comparative ratios have been leapfrogging, and I think it's going to continue to climb higher here during this relief rally period, right? I'm not against those short-term relief rallies in markets. They are part and parcel with major bear market corrections, and it is going to happen in equities, as we'll talk about as well. But what I need to ask here is whether or not you're trying to do short-term trades like that or long-term buys in order to ride the next major cycle for a year, 2 years plus. That's the question here. And I think it's disingenuous when we have small moves to say, see, that's the bottom here. It's not only disingenuous, but the problem is that it's going to leave you in a position where you think you've made the absolute pick, and if markets roll over, you start second guessing yourself because you went all in at one price. Dollar cost averaging doesn't have this effect because you slowly get into the market over time. And that's the key thing here that I want to emphasize. If you guys are wondering when we're going to flip bullish here, when I'm going to get optimistic here individually about markets reversing, it is going to be when we get back above this 4-hour 200 EMA and when we hold above that range for a prolonged period of time. Taking a look at previous bear markets, this is an incredibly relevant indicator. We can go back during the previous bear market here and see exactly how it had played out, with the 4-hour not being able to be held as support back here in October from September of 2018, and the correction following afterwards. Only until we were able to get above here and retain it as support did we get the final necessary move higher, a 12.46% bump up in Bitcoin's price in order to really reverse the trend and retract all the way to 14K in just a matter of a couple of months. That is going to be the sign here where we get in. We don't want to linger around in the market hoping that we got a good price. We want to make sure to get a solid entry when the trend is starting to reverse. And the great thing is that if you would have waited here just for a slightly higher entry, you could get in at 3,800 still, well within the lower bound range here. It's difficult to say that you'd be able to call the absolute bottom here at 32,000. It's just not likely to happen. At the same time, we waited for confirmation. We were patient here and were able to get a good entry above this 4-hour here if we just simply held off from doing anything too rash or too immediate. And that's exactly what we need to see here. Unfortunately, we have not seen that here. Every time we retest the 4-hour, and I think we've got a chance here possibly in the coming days to retest that 4-hour 200 EMA. It's going to be a question of whether or not we can not only get above it, but turn it into support. And that's going to be a very big challenge here, right? As we have that EMA riding here, we need to be able to see that price is able to rebound off of it and give us a sustained signal that the market is ready to reverse here. We have not gotten that yet. Now let's go ahead and take a look at equity markets here, right? Equity markets have gone through a pretty brutal correction. The NASDAQ 100 down from all the way at 16,500 down towards around 11,000 on the points for the index. This essentially means we've gone through a 30% plus correction here, around 34% from top to bottom. And a lot of people, as with typical bear market metrics of 20 to 30%, a lot of people are really excited to buy this opportunity. And again, like with crypto, we are at discount territory that historically makes sense to start a dollar cost average entry into the market. But going all in might be a bit risky, especially if you're not willing to wait until a longer period of time for prices to come back up to that range if a further dip for that matter, occurs in the market. And that's the big problem that a lot of people don't think about when they're trying to catch a falling knife. Because all the while, we may be just having a typical 20-30% bear market, many of which we've seen here over the last decade, back here in February, March of 2020, back here in September 2018, and many of the mid-cycle, I would say, kind of corrections we've had, or mid-cycle bear markets we've had during this decade-long rally here in price that we've had. Many people have gotten used to the good times, the idea that the Fed is going to come to the rescue and drive up asset valuations. But looking back at history, we can see that from time to time, we get worse corrections than that. We get corrections that go down 50% plus. And during the dot-com era, came down as far as 83% for technology companies. The same goes here for the S&P 500, right? Nice typical 25% pullback from top to bottom. A little bit of relief coming into price, possibly setting up a relief rally. Many people thinking that it's playing out exactly like these previous bear markets, these miniature ones of 20-30%, whereas back in the past, we've had much heavier corrections here in price, like we did at the peak of the dot-com bubble and here in 2008. Now, a lot of people, again, will assume that this just simply can't happen, that the Fed will come to the rescue. And to be honest, I understand where a lot of people think that way. We have been trading and investing off of that thesis for a long period of time. But the dynamic that changes all of that is inflation. And it is important to note that while we may get relief rallies in price, right, they can be incredibly deceiving here, right? And they come in at those even discount ranges that many people assume are safe buys. For example, we'll take a look here at the S&P 500, right? 30% correction, roughly speaking, here from top to bottom. A lot of buyers coming in, taking that opportunity, driving up valuations up to 21.8%. And then thereafter, and this is a good way to kind of put it in perspective, let's say you even timed that bottom perfectly, or that temporary bottom. Afterwards, it rolls down and down, you lose all your gains, and now you're in the red, and then maybe it comes up a little bit, and maybe you're in the green, but then it comes down again, and you're down 30% under entry. Very likely is the case that you would have sold your position at a loss. You would have gotten excited about the gains you made. You could have even timed that temporary bottom perfectly. But as it starts to roll over, it doesn't fully recover and get back to those all-time highs and start charting higher, then you start revenge trading. You start getting out of your position, start shorting the market. You do all kinds of crazy stuff because we are people. We're emotional. And until we find a strategy that's going to help us follow a disciplined strategy that assumes the worst case scenario, especially in these macro times, we are going to get burned. This happened not just back in the early 2000s, it also happened during the recession, right? We had, for example, another 20% correction in price, typical bear market territory, 20-30%. Buyers came in to try to find value opportunity. Prices went up 15%. We got a nice little relief rally here going into the spring, and then it rolled back down to a net loss here, even if you picked that temporary bottom of 46%. Not a solid entry point. At least it looked good at the time. Now it doesn't. That's exactly what we need to be wary here of, is the idea that even though we might get some kind of relief rally going into the summer or fall, that it can quickly correct here as we enter into a very likely recession. And this is something that I think at this point, most of us agree is likely to happen. And we can start to see this manifesting in the indicators that people are getting bullish about. For example, we can take a look at oil here. Oil had a really solid dip lower here, 8.2% yesterday, clearly breaking out of what was a technical wedge since back here at the start of the year, likely signaling that if we get continued further weakness signs here, if we break below the 100 range and have a weekly close below there, if we can't hold on the typical support range of the 200 EMA here on the daily chart, we could be in for a top on oil. And again, this has been one of the metrics we've been looking for the Fed to start reversing course on monetary policy. Once it's able to tame commodities, that's going to get markets excited. But there's an important catch here. All the while here, we may see markets taming here, that being specifically commodity markets, which have been one of the big drivers of inflation for energy prices. It's important to signal why and understand the signal here as to why prices are going down. And especially if they start to go down significantly, it will likely mean that the Federal Reserve did exactly what its intention was this entire time. And that is to put the economy into a recession. And I got to be honest with you all, recessions aren't entirely good for asset markets. People's incomes decline, they get fired. It's not only just terrible for the underlying economy, but if you think about markets, markets are about inflows. And if people don't have disposable income, they're worried more about still paying for the heightened cost of goods and services just to get by and live day to day. And they're not seeing wage growth. We're effectively seeing stagflation. People don't have that disposable income to go out and buy up assets. So it's important to keep that in mind here, that all the while we might see some of these indicators topping here, while it might provide temporary relief in the NASDAQ or the S&P 500, we need to think conservatively here. And we can already see here in the treasury yields for the US 30-year or the US 20-year that we are seeing a significant decline here. The market is starting to factor in the fact that the Federal Reserve here, the Fed, will likely not be raising interest rates as aggressively. And this is actually probably a big mistake. The reason why is because if we look back in the previous times, back in 2006 to 2008, the Federal Reserve repeated these same mistakes here. As oil and commodity inflation started to go down here, they didn't take the necessary steps to keep interest rates heightened, have a bit of extended pain here, and have a real proper recession. Because if the Fed starts to backtrack here, that demand will come straight back into the market. We need to have the Fed hold up rates here in this range. We actually don't want to see the 30-year drop too soon. But I have a feeling the Fed is going to be pressured big time here. And the reason why? Mortgage rates. If you guys need a chart to understand just how bad it's about to get in the housing market and in assets abroad, look no further than the mortgage rate for a 30-year fixed mortgage. This is the general decline of mortgage rates since back in 1981, where they peaked at around 18.5%, all the way down to the lows we saw back in December of 2022 at around 2.6%. We have seen not only one of the most rapid expansions, but also one of the starkest expansions here, both in actual percentage terms, but also in actual real growth here. If we take a look at the log scale coming off of those generational lows here, right? We couldn't push it down much lower than 2.6%. The bank's got to make some money and protect against some defaults of mortgages. Now at a point here where we've gone from 2.6 all the way up to 5.8%. A 118.8% expansion, the biggest of the last 4 decades here, signaling here that we are likely in for a lot of pain here in the short term, especially if mortgage rates hang here for a quarter or more. That is going to be bloody for the housing market. Practically cut off an entire generation of demand for the housing market. And the reason why is because the cost to borrow money to buy a home has now effectively doubled. So what's going to happen? Housing prices have got to come down dramatically, especially if rates stay at this rate, because there just isn't going to be the same demand as there was before. People can't afford it. There's layoffs in the economy. There's about to be a lot more pain in the near future for the airline industry and cruise lines. A lot of the initial dominoes we'll talk about on our macro update on Monday. A whole lot of dominoes just waiting to tip over here in a higher interest rate environment. And we have to be prepared for that when we're talking about our entries into crypto. Until we get above reclaiming that 4-hour, we are likely, even if we get above there, or if we, for example, get up to the range, retest it, we are likely going to roll over here in asset prices. I don't know exactly how long it's going to take here, and that's why we've got that 3 to 6 month window. I think that that's a decent gauge to finding the bottom. We just got to be patient here, guys, and we got to wait until the market gives us a favorable entry, or we follow our routine strategy. We know we're in the later innings here of this correction. We've gone through a lot of the harsh portions of it. Now it's time to slowly dollar cost average, keep humble, not try to pick bottoms, and simply wait for the market to give us that opportunity to make an entry. A disciplined entry that is not going to come with the emotions of trying to catch a falling knife or playing with too much leverage. You guys know I'm not about that here on this channel. I don't want you to fail. I could make a ton of money promoting referral links, doing all this stuff, but I don't do it because I really want you guys to succeed. And those of you who have been able to stick around, listen to me ramble here to this end point, I can't guarantee that I know everything, but I have to say if you've got that discipline to stick around, you guys are in the winning camp here. You're much more likely to succeed if you can keep these base principles in mind. Make the market beg for your money. Make it give you those solid generational opportunities that are probably going to be much lower than where we are now. It's just an important thing to keep in mind. And when we get the signs of strength here in the market, I got to be honest with you all the while, you don't have to sell everything. But when we get these relief rallies, they're called relief rallies for a reason. They provide temporary relief to the market, and they should be taken advantage of here if you're looking and expecting for that longer term dip in markets. But you can always do a 50-50 approach. If you're not 100% certain that this is the narrative that you want to follow, if this is what you think is going to happen, you could always take half of your positions off the market into cash or into a safer asset like Bitcoin, and then wait to see what happens over the next month or two. So anyways, guys, I hope this video has proven helpful for you guys about what kind of signs we're looking for, what macro factors we're keeping in mind. If you enjoyed this video, consider dropping a like, consider subscribing and hitting the bell icon so you don't miss another upload here on the channel. But the biggest thing, guys, is to stay safe, trade smart, and don't do anything rash. Wait for the market to give you the right opportunity. Thanks so much, guys, for tuning in today, and I'll see you all in the next one. Take care, everyone.